Welcome, everyone. This is our fifth Q&A session. Today, we're welcoming Andrés Dancausa from the Venture City. It's super nice to have Andrés here, and we'll give him a chance to introduce himself in a second. But before doing that, I'm actually going to pass the mic to G, and G is going to give us some kind of house rules on how we should interact with each other and behave during this next 50 minutes or so.
Thanks, David. Hello, everyone. So this is first and foremost a Q&A session. So we want you guys to ask all the present questions that you have to Andres, and we have two ways for you to do so. If you are a little bit shy, you can just write your questions on the chat box that we have, and we will then read the question to Andres. So, but if you like to ask the question in person, the way you can do that is to also write the question in the chat box, but between parentheses and in caps lock, type live. For example, if you look at the chat box now, I said between parentheses, caps lock live. Andres, what do you think is needed to foster a good relationship with investors? And when the time comes, we will ask you to ask the question in person. Two more things. If you can, please enable your camera and keep your mic turned off until you ask the questions. Thanks.
Awesome, G. Thank you for that. Before I let Andres introduce Andres a bit better, I just want to say that it was really cool to meet Andres, because when we launched the podcast, we reached out to our network, asking people, who should we talk to? Why should we talk with them? Whatever, whatnot. And Andres was introduced to us by a Portuguese founder, whom I know relatively well. And he said that Andres, and generally speaking, the Venture City, were someone super interesting to talk to because they were very relationship based. And I asked, what the hell does that mean? And he said, most VCs are transactional, and these guys, they actually care about us. They actually help us out. And I think that's a great way to introduce Andres, even though I didn't say a thing about about the company or himself professionally. But Andres, maybe introduce our guest, and then let's shoot it to him.
Yeah, but I would actually say let's just kick it to Andres to let you, Andres, tell us who are Venture City and who is Andres. You probably do yourself much more justice than I would.
Yeah, so let's start by the company, by the Venture City. We are actually we don't like to say that we are a fund or a firm, or we try to avoid to use this kind of words to define the Venture City, because what we think is that we are a platform to help entrepreneurs to disrupt industries. That's our main goal. And it's true that we are doing this through capital, by investing in companies, in early stage companies, in Series A, or even in seed, but also with knowledge. And I would say that this is one of our main differentiators. We invest. We have invested, or we founded the company 5 years ago. We have already invested in 115 companies across the United States, Latin America, and Europe. And I would say that the common denominator we are providing, or the value we are providing to the companies, is mainly the knowledge we have coming from operational experiences, and that's probably a good way to introduce myself, because my background is more like an entrepreneur. I founded 2 companies before turning into investor. My first one, my first company was headquartered, which is a price comparison site, actually leading the category here in Spain. That was back in 2007, something like that. I don't want to remember exactly the date, because it's like giving you a lot of information to figure out my age.
Don't want to know your age, Andres.
But yeah, 14 years ago, we started this company. And my second company, that was a kind of company that grew a lot. We became a team. We had a team of more than 150 people leading the category here in Spain. Then the company was sold. So I think this is kind of success story. And I got a lot of operational knowledge through that startup. And then I set up a second one. And in this one, actually, you know, we always say that when you are an entrepreneur, you understand the ups and downs, you know, and in this company, to be honest, I had a lot of ups, but unfortunately, we didn't build the kind of company we wanted at the beginning. So we closed after 3 years trying to build a private tutoring marketplace to lead the category worldwide, which was our goal. And I would say that I learned a lot in those 3 years. I don't want to compare both experiences, but I would say I learned even more, because when you fail something, you are more pushed to learn. You know, I would say one of the quotes that I really like is that pain plus reflection makes progress. You know, and I could experience this at that stage. Then I met the funding team of the Venture City, and you know, to be honest, now that we are going to talk about venture capital, I didn't want to work for any other venture capital in the world after my two startups. But I met the team, I saw the incredible knowledge they had, and I joined the team 3 years ago, first leading our first ticket program, where we invest from 100,000 euros to 300,000 euros in very early stage companies, even some of them even pre-product market fit companies. And in the last year and a half, I am leading the fund in Europe as a general partner for the Venture City. So that's pretty much, we usually say that we are operators turned into investors, and that's the main value we are providing to the community, you know, this operational experience.
Yeah, I'm curious, Andres, because having this accelerator model, even though that's not where you are not now, the first ticket program, but we're here to also talk about founder-friendly terms, and what I don't like about many accelerator models is that they can become quite grabby when it comes to actually helping the startups in the end. What have been your thinking around that inside the Venture City?
Yeah, so you know, it's true that to speak about accelerators probably is not the same thing when you are talking about accelerators in Europe or in the States. I would say that in Europe, the accelerator word has like a very, in some cases, really bad, let's say, brand, even if there are some of them which are really good platforms to start. Yeah. But it's true that we could understand this differentiation from the very beginning, you know. I would say that the main reason why you got this feeling about the accelerator is because in some cases they are just thinking about the short term for the company. You know, the truth is that especially when you are leading or we are launching an accelerator, you should be thinking about the long term. And it's true that in Europe we didn't have, at least a few years ago, a lot of long-term investors, even if we were talking about technology. So probably because of that, that's why you have this feeling about this category in the industry. Even though I think now in 2021, we have really good examples all over Europe, not just companies like Waida or Techstars Europe or all of these ones. I would say that there are even small players that are doing a really good job.
I'd like to ask you to reflect on something, which is I started by introducing you by saying how you were introduced to us as a firm and as an individual, of being less transactional and more relational. I'd love to ask you, why do you think that's said about you?
Well, actually, it's not because we are nicer than others, to be honest. I mean, the question would be why we why do we consider that becoming a founder-friendly investor is the best way to return money to our limited partners? That's the main question, because at the end of the day, my job is to return money to our limited partners. The point is that, again, it's not because we think we are nicer than others, or it's not because we were previously entrepreneurs, or of course, it's not because we are an NGO, okay? Actually, the reason why we consider that becoming a founder-friendly investor is the best way to give the money back to our investors is because we understand something that I would say is not very often understood in the industry, which is the power law. You know, the power law is basically a mathematical functional relationship between two quantities, where relative change in one of those quantities results proportionally in another change in a bigger quantity, you know, independent of the initial size of those. You know, I mean, let me put you an example, because probably if we speak in these terms, is more difficult. But in layman terms, when it comes to VC investing, it's, I would say, common to make more money from your single best investment than all the rest put together. That's the point, you know. Usually when we are investing in a company from our fund, we are targeting this company to become a fund returner. Let's say that if we have a fund of $100 million and we have invested $10 million in a company, we want this company to multiply this amount by 10, you know. So if you do this, of course, unfortunately, the average is not to multiply your return by 10 in every single case. But because you understand this power law, you want to get the best opportunity ever, you know, and you can't get the best opportunity ever if you are not competitive in your terms. So I would say, I'm now talking from the VC perspective, okay? Then, of course, there are a lot of things related to our mindset and our mindset of giving back to the community. Of course, there's a lot of that, but just from a very, let's say, economicist perspective, the reason why you should be, as a VC, a founder-friendly investor, is because you really understand the power law. You know, that's the point. The consequence of this, sorry, Andreas, you.
Yeah, now I was just about to say that to what extent do you see, because you said, well, that you believe you understand that better than others, and that's why you actually go that route. But I would say, when you come into a Series A round and you have other investors beforehand who haven't shown the same, you know, had the same insights, how do you deal with that when you see terms that are already in play?
Well, that's a really good point. That's a really good point. To be honest, there are a lot of founder-friendly investors, and a lot of founder-friendly VCs. Of course, we are not the only one in the industry with this approach. That's for sure. But it's true that sometimes you are investing in a company that you see that they didn't get like this kind of investment from the very beginning. So usually it's hard. The conversation between the founder and the investor. That's why it's super important. Instead of trying to get the best price for your company as entrepreneur, like the higher price, it's always better to get the best investor with the best mindset behind the investment. You know, for us, is usually we try to deal with them like by. I mean, we are trying not to focus on getting protection from the downside, but investing to the upside, you know, and that's the rationale we usually try to explain to them. Okay, so for example, let me put you a very specific example, and it's a very good example about how do we behave. You know, a company, let's say that we have invested in a company. I'm not saying that this is a true story, but it could be a true story. Okay, let's say that we have invested in a company, a Series A, and we usually don't put a limitation for the salaries of the founder. Never. I mean, it's because we trust in the founder, because we think that he's a good manager of the company. We don't think it makes sense to have the founder sending an email to me every 12 months saying, hey guys, I would like to get 10,000 euros more for my salary, you know. I think it doesn't make sense. I mean, first of all, because the founder, as manager of the company, he has fiduciary duties, which are more, let's say, strong than a contract. But especially because if the founder has raised a round of 3.5 million and he's getting a salary of 1.5 million euros a year, my problem is not the salary. I have a bigger problem. Probably the salary is just the big elephant in the room, you know, but there's something behind. So this is the way that we think. Okay, if we were thinking about getting protection of the downside, probably because of this rationale, you should put a limitation to the founder salary. But if you are thinking about the upside, which is again our business, because we understand the power law, the truth is that you don't care about that. Again, first of all, because he has fiduciary duties, but second, because you want him to go fast, to focus on what matters, and his salary don't really matter. You know, that's a very specific example that could have happened to us, but it's happening always. The truth is that if you go to the States, which, you know, we invest in both regions, which is at the end of the day a more mature ecosystem, you don't see these kind of practices. Yeah. And if you go to certain countries in Europe, you see this kind of practices more often.
Yeah, yeah. No, it's quite widespread in Europe that you have investors caring a little too much about those things.
Yeah, I mean, it could be a problem, of course, but you know, this is not the real problem. You know.
How about Andres? Because it's always when you invest, everyone wants to be good friends, and we are on this journey, and everything is going to be good. But then when it turns out that the investment isn't that power law outcome, so it isn't on the left side, it's more on the right side of that curve. How do you see yourself acting in that space in contrast to others, and what are the important things for founders to think about, and also for VCs who want to be founder friendly, to think about the bad case scenario?
Yeah, of course, we think about that. It's our job, of course. That's the point. So let's say that, or let me clarify that thinking about the upside doesn't mean that we are not thinking about the bad case scenarios. Okay, that would be like my first point to answer your question. The second point that I think everybody is understands this is that VCs are contractually bound to be LP friendly first. That's the point. So meaning that they have to produce returns. You know, we have to produce returns. So that's often what drives is that we will push for different evaluation, various types of control, and we will try to host of other behaviors. You know, you try to control some behaviors coming from the founder, but those behaviors, you know, in the stakeholder agreement, there are mostly two kinds of things that you can regulate. You know, one is the behavior, the economic rights. You know, basically, what is your upside? This is, you know, the financial benefit you receive from the company that is doing well, and control. You know, who will decide the future of the company? You know, so the point is that you as investor need to align your goals with the founder goals. I would say that when you have these kind of situations, or that you have already mentioned, it's because you didn't align in the most of the cases, you didn't align your goals with the founder goal. Okay, let me put you a very clear example. I had actually this morning with a founder. He's launching his startup. He's in, let's say, in his month 4. He got a really interesting check from a private equity firm, because the guy is super smart and the private equity firm wanted to invest, the term sheet this private equity firm sent to the founder is the kind of term sheet that usually a private equity firm sends to a company. The point and the thing I try to explain this morning to the founder is, hey, you are let's say a dolphin, and you are talking to people that want to milk you as a cow, so you're not gonna get like a good position with those guys in the future, even if they are the nicest guy in the world, but they don't really understand your business. You need to have like the control of the boat for the next years. You don't really understand your business yet because you've just started. You need to find product market fit. It's true in this case he had like incredible figures and unit economics, but those are going to change very fast. So you can't close your agreement now with these guys if they don't understand that you should be free to do whatever you want in terms of the business, because you are now building the business. And it's not that these guys are doing bad.
No.
It's not that those guys are that they are not nice guys, or it's not even that they are not professionals, because they think you are a cow and you are a different animal, so they can't milk you. Okay, so I would say that this kind of situations is because this problem. So in our case, for example, if we want to sell a company by 500 or let's say $1 billion a company, but we realize that the founder has just 30% of the company right now in Series A, we don't invest, because we know that in a certain moment this guy will probably reject, or at least the chances to reject are higher, so instead of trying to put some clauses in the sales agreement, say, hey, you can't leave the company, you can't go if you have wherever personal reason that force you to leave the company. Instead of working on those clauses, what we try to figure out if this guy is going to be in this case a scenario, and if he has enough skin in the game to do whatever it takes to bring the company to $1 billion for a company. You see?
I loved the dolphin and cow example. I can see us making a GIF with it. But on a more serious note, we've been talking about some examples, and that's really interesting. But maybe I'd like to step back because we do have in our community a bunch of first-time founders. And I think sometimes for them, this might sound like wishful thinking and they don't really get what we're talking about. And I'd love to ask you, Andres, would you thinking of first-time founders specifically who are probably in the beginning of their journey as an entrepreneur, so probably about to raise their first round or maybe talking with angels for the first time, what kind of tips would you leave to them about, what should they be thinking about when having these conversations with potential investors?
Yeah. So first of all, is that you guys as entrepreneurs should due diligence the investor. That's the first thing. It's key. I mean, usually I did my mistakes too, so I understand very well this kind of thing. When you are raising capital, first of all is to call other founders' portfolio of this investor to understand if this is a good investor, of he or he is a bad investor. That's one of the key things. It's really simple thing, but you don't see this very often. super interesting.
Yeah,
It's
completely.
very. So that's the first thing, ask to the community about the investor. Okay, that's the first thing. Second thing, ask about his goals with investment, size of the fund, what kind of multiple is he looking for, what kind of companies that he want to build, what kind of, let's say, support will he bring to the company. These kind of things are main points that you should due diligence first before talking to investors. Then there are like some, I would say, key things that you should defend when you are closing the negotiation. Usually for me, the most important things are related as a founder about the question of who decides the future of your company. That's the main thing. Okay. And second, the economic rights. What is your upside? Okay. And I'm saying this because in the same way that I have highlighted the point that becoming a founder friendly investor is like the most, for me, intelligent point of view when you try to do your job. I'm saying this because I see a lot of founders making a mistake from the founder side. They usually related to the price. The mistake that the founder make is focusing too much on getting a high price. I've seen this many founders doing the same thing. And the point is that sometimes they reject good investors and put the company in a bad situation, facing a down round a year later. This is very often all because they were obsessed with getting a high ticket price for the company, and it doesn't make sense. So I would say if I were a founder again, I would focus first about who will control the future of the company, and second, of course, the price and the economic rights of the founder. And then it's about discussion. Then you can do whatever you want, but you can decide on dividends, liquidation preference, voting rights, I don't know, protective provisions, anti-dilution clause, even if I don't like this clause, but there are thousands of things that you can negotiate with the investor.
How do you go? How do you go about, Andres? Because we have our own kind of program inside of the community. We're trying to help founders understand several of the terms you just named. And I'm curious to know, how do you guys go about it? Because there is an asymmetry of information here, which puts you guys at always an advantage, you guys and any investor, because the business is, looking at these terms regularly, while a founder, even an experienced founder, does it 4 times? So how do you go about also educating them in that negotiation process? Of course,
we try to educate them always. First of all, by asking them to contract out a lawyer, a good lawyer. That's the first thing we do. If we see that the company is not well surrounded in this aspect, which is key. And second, we try to explain them every single point. And we have had a really interesting conversation a few months ago where we had to educate the founder and other co-investor. And again, it's not because we think we are smarter than others, but it's because you need to be aligned with the whole cap table, and sometimes it means that you need to educate someone if he's not educated, let's say, in this busy world. So for us, the more aligned the founder and the rest of investor of the round is, the better, because you are avoiding problems in the future. So and you get alignment through education. You don't educate your founder, you just try to have him signing a clause that he doesn't understand, you will face a problem. And then the situation that Andreas said before comes out. It's the best way to have problems in the future when a founder doesn't understand the stakeholders agreement.
Yeah. I think it's a super important point because, as David also said here, many of them are first-time founders and they're raising their first round, and oftentimes that's of course an angel round, and unfortunately, or angels in Europe aren't oftentimes very educated on what's actually the VC route and what's okay and kosher and so on, and then the founder really needs to take on them to know more in a way than the angels, because you can quickly get caught up by following a group of angels who are doing malpractice.
Yeah, it happens. But again, we are so lucky now. We are now in 2021. So when I studied, I would say you didn't know what. I would say so now the truth is that there is a lot of kind of investors. The most of the investors have already a trajectory, so you can go deeper on them and you can understand. And yeah, sometimes you don't get the best investor because you didn't know it, or because he didn't understand the thing, especially when you're talking about angels, new angels. But a lot of other times the investor is great, and I would say that the majority of the cases are positive in our case. Sometimes not, but the most of them nowadays is like this.
Andres, I have a question because you talked about decision-making rights and controlling power, and some people talk about the board as that's where they add value, and others say that you can add value anytime, anywhere. The board is for control. What are your views on that?
Well, that's a really good point. Also, we have our own view on this. We think the board should be a meeting to add value. I'm saying this, even though I think that you could add value every single week without this formal meeting in place. The second part of the board, which is how to manage, who control the company at the end of the day, what we are doing usually is to give to the founders like a kind of super voting at the board level. Of course there are some decisions that we control. Everything related to our economic rights it's in a way controlled by us and by our stakeholder agreement. But in terms of a lot of other things, you try to get alignment, and if there is no alignment, at least at this stage, Series A, pre-Series A, something like that. Maybe later it's a different game, but at least at this stage, we prefer the founder to decide. So that's why we set a board a few weeks ago. I can say the name, but there are of the company, but there are 2 investors in the board with voting power, and there are 3. Or there are 2 founders, but one of the founder has 2 votes. So that's sometimes we don't do what we claim to do, but in this case is a really good example about how do we manage these things. So there are 3 votes for the founding team, 2 votes for the investor, and it's not it's something probably like from our perspective founder-friendly behavior. But again, it's not because we are nicer. We want to get the money back to our investor. We go for the returns, but we think it's better.
I have I have a weird question to ask you, Andres, which is, and this is me just opening the kimono a bit. So when we started the podcast, as I said, I asked around the network, and that's how we got to you. And I actually had many founders replying to me saying, "Why the hell do you want to talk to VCs?" And there are many founders that seem like they have a little feud with VCs, which is really weird for me to understand. I'd love to have it kind of your more macro thoughts on this. Why do you think that is the case? Why the hell? And have you had any interactions where you feel like there is some level of hostility on the founders towards the investor
Yes.
at the beginning? And how do you deal with that?
No, of course. I mean, I put my example as not as a founder, as a worker. I mean, when I set down my second company, I didn't want to work for VCs in general. I mean, that I don't know if I could speak about hostility, but the truth is that I rather prefer to work for a different kind of company at that time. I understand the point. The reason behind this is because it's very hard to raise capital. Usually the time is against you and not against the founder, the VC. So there are some investors, not all, but some investors that take advantage of it, and actually, by saying, yeah, let me know in the future, and the first day that you got your lead investor, they want to invest, but they had the same information 5 weeks ago. I understand this feeling really well. One thing that I see very often is that I'm seeing like dozens of companies every single week. So I learned a lot, to be honest. I am in a privileged position because I'm talking to super smart guys, and they are willing to teach me about the business. But this knowledge is not bilateral always. So, I mean, if I were a founder again and I would visit a VC and I would explain him the business, the minimum request I would have is, please give me feedback. Then I will decide what I'm gonna do with the feedback. I can listen your feedback, or I can just remove it from my head, but at least feedback. So, and when you're a founder, you visit one, you visit two, you visit thousand, not thousand, but a lot of VCs, and a lot of them don't share their feedback with you. And it's a pity. One of our, in the venture city, one of our main says, we repeat this, by the way, every single week in a 360 meeting we have. We repeat this. It's like like a clan saying always the same thing. We always say no empty no's. We consider it like, so it's a very simple thing, but every single time that I am giving like interesting feedback, you can't give interesting feedback to everybody, and sometimes you just say, well, my initial feelings about that, but I would need to build more on top of this, But in the cases that we are providing well thought feedback to the company, the experience is incredible, because they are so grateful for something which shouldn't be the case. It's like, why? This is my fault. I for sure I am wrong. I was having fun the other day with one of our colleagues here in the venture city, because I say, we have a very hard job, because we are saying no to entrepreneurs who for sure some of them will become millionaires or billionaires in the next 5 years, and now you are saying them no. So probably in 5 years time, we are going to have a lot of people in the street saying, hey guys, you didn't invest, and now I got a billionaire business. And
maybe they won't like you.
Yeah, exactly. And and that's my position. So we are in the front line of a lot of conversations. So, and so I understand if the general practice of the ecosystem, and going back to your question, I understand that if the general practices of the VC world is learning from the founder, but not giving them feedback, scheduling meetings, but in the next 5 weeks, because you are in a rush and I'm not, and all of these kind of practices, I can understand that a lot of founders don't want to talk to VCs, because what they see in a lot of cases is I'm giving you the rights instead of money. Now I can get this money through other vehicles or through other instruments. So why I should speak with VCs? And a lot of them don't want to deal with us. I've spoken with some of them that they didn't want to deal with VCs, But the truth is that thanks God, everything is changing very fast. And thanks God, now we have a lot. The competitive landscape for a VC is different. So that's why platforms like the Venture City and growing so fast, our mindset is, okay, it's not about the cash, it's about operational knowledge. Then you have to give feedback. Then you have to work with founder-friendly terms. Then you have to convince the founder in order to get the best asset in your portfolio. And if you don't operate like this, you will miss the best opportunities. And if you miss the best opportunities, you won't return the money that your investor, your limit partners is expecting from you.
Where do you see, Andres, once the investment is made, where do you see both many investors, but also many founders going wrong in actually establishing that good working relationship?
Yeah. I don't know about other investors, but it's true that we see a lot of we see some founders who don't establish the right relationship with the investor by probably not reporting every single month or every single quarter how they are doing with the business, and it's not because you need to report to the investors, it's because the more your investor knows about you, the more your investor understands your business, the more, if he has something to add to the company, the more he will be able to add, So let's say in our case, we have this operational knowledge. To be honest, we are pretty lucky with our founders, and I would say that the majority of them are always sharing things and the reports with us, But it's true that in some specific cases, we didn't get this information, and at the end, you go to the board and you don't know how to help them out. So that's apart from the point that it's very useful for you as entrepreneur to share your progress with your investor, and it's fair to do it, Apart from that, I think it's the best way to get value from the investor, because one thing that you can't discuss this is that a VC as investor has like a really good perspective of the ecosystem. We are always watching different practices, different knowledge, so we learned a lot. So it's our goal is about getting this knowledge and then put this knowledge on the company. So it's interesting to have this kind of player with you for the future of the company.
Speaking of reporting, and I think this might show the misalignment between power between investors and founders in the beginning or in the early stages, how they think about each other. Because how do you think about how founders should report? Is that on you to tell them and say, I want it like this and I want it in this system and blah, blah, blah? Or is it on the founders to build it as they want it? And then you as the VC need to adapt to that. You can of course come with advice, but it shouldn't be, you don't see that relationship as being you demanding and them.
Yeah. So let's say that there are two angles for this question. One, let's say, weakness of the VC could be that because you have a lot of businesses to understand, you have your own template. Mm-hmm. And you want to understand everything through that template. This is a huge mistake. So and you should adapt. You should adjust yourself to the company. So this is an angle. The second, a different angle is coming from the entrepreneur or the founder side, because I really understand my business and I am monitoring those two things. I report on these metrics, and I don't accept you to your input to improve the way that I am reporting to you, or the way that I am sharing my product with you, or the way that I am understanding the business. So both perspectives from my point of view are wrong. So in our case, we don't have a template, but we work proactively with the founder to get the kind of information, the level of information we get. We want from the founder. So in the first report, usually I sent like let's say a really I think interesting email. At least we put a lot of time to make it interesting to explain, hey guys, I think this metric could be more interesting. For example, one example last week, we had a company that is starting to report to us, and I said to them, maybe I would be focusing on this metric. I think it's important for you to manage, to control the cash you have in the bank. And please add a last point at the end of your email saying, what do you need from us? The typical help paragraph when you are asking something to the founders. The feedback was really well received, and for sure the founder is gonna do the following. So I mean, I don't think having templates is the best way to communicate with your company when it comes about reporting. But in the same way, I think the founder should listen the investor.
Now, and the reason why I asked, because to me that point is quite obvious as well, but you just have so many founders obsessing about what do the VCs want and what do the angels want, and that's just the completely wrong framework or frame of mind, because it's about what you need to run your business, and then the investors need to add value to that.
Yeah, and this is talking about founder-friendly investors. This is a good way to understand his mindset.
Yep.
I mean, if the VC is thinking about what do I want from my side, this is not a good investor for you. The good investor is what the company needs. Exactly. That's the point.
Completely agree.
Andres, we are on the clock. It was nice having you here. Maybe final thing, if I'm a founder who's listening to this live, or that is listening to the recording of this, and I really liked everything you said, what is the best thing for me to do? Should I apply to the program at the Venture City? What should I do?
Yeah, no, let's make it easier. Apart from applying in our website for sure, I'm happy to receive. Let's put here. How many people are going to see this?
Too many,
there's
too many, Andres.
Too many to put your email, I'd say.
Well, no worries.
Definitely put your email. I guess you have it in your LinkedIn as well, right?
Yeah, exactly. I'm gonna put my LinkedIn. Yeah, but
nice.
Yeah, happy to receive them. But also we have info. Here you have my email too, if you want to share it. Okay, yeah. And then we'll manage it.
Awesome. Andres, thank you for time. Thank you for your availability, and thank you for joining us yet again at one of our initiatives. Super cool.
Thanks to you guys. I think you are building. Thanks for having me by the first, and I think you're building an incredible initiative in Europe. So I really, I feel really proud of being part of this dream. Thank you.
Thank you, Andreas. Before we round it off, what's happening next on these Q&A sessions? Who are we welcoming and why?
Next time is on Tuesday, the 14th of December. It's with someone who Andres probably knows, Stefan Moraes from Indico Capital in Portugal. And Stefan will be talking about exit strategies and how to think about them as a founder and work with VCs to develop and execute on them. So that's definitely going to be exciting.
Awesome. And on that note, see you all. Thank you for joining us and stay in touch. You can reach out to us whenever you want. Bye-bye.
Thanks, everyone.